Better than 2018. Look, I think we've actually had a decent year. I talked a lot last year about some of the changes we'd made on the business front. This is a business and an industry where actions and their consequences often have some very large gaps between them. And I feel like in 2019, a lot of the hard work that we did in 2018 started to pay off. On the performance side of things, we ended up having a pretty good year in the international fund thanks to a very, very strong back half of the year. And the Australian fund as well, second half of the year was much better than a very poor first half. More importantly, at lots of the underlying investments, we saw a year of progress. It's going to take time, particularly in the Australian fund, for some of that progress to turn up in share prices, but we did see some businesses move in the right direction. We had some big wins come off in 2019, particularly in the international fund. Blanco, which has been our largest investment there for a couple of years now, kicked some goals operationally and also saw that show up in the share price. We had a little bit of luck with a company that's listed in London called ThinkSmart. That company sold its business to the Australian listed company called Afterpay, but kept a 10% stake in Afterpay's UK business. It is growing very, very, very quickly, and we've seen that share price up a lot. Although it's only a small investment, it made a fairly significant contribution to our returns. And some of the newer US listed investments have also performed well, particularly Zebra Technologies. Again, some good underlying operational performance combined with share price movements there to contribute to our year, which was in excess of 20% over the year. In the Australian fund, the two good performers were stocks that we've held for a very long time, Macmahon and Enero. Enero we've actually held for 10 years now. Just shows that sometimes you need to be patient with these stocks. And with both of those businesses, I think we have seen a lot of progress over recent years that didn't necessarily turn up in the share price. And this was the year where we banked some of the returns. We've got a lot more in that portfolio that I think you'll see in 2020 be a similar situation. From a share price perspective, certainly in our Australian fund, Thorn Group has caused a lot of pain. The share price is down a lot over the past year, and we've actually added to that investment. I actually think it's one of those stocks where there has been some progress made throughout the course of the year. We said at the start of 2019 that in our Australian fund, we wanted to force change at some of these businesses where we thought it needed to happen. We've been pretty successful there at MSL Solutions. We've been successful at Logicams. That company has merged with another privately held entity. It's got a new management team and a new board, and we're seeing signs of progress there. And at Thorn Group as well, it's a complete replacement of the board. There's a new CEO starting in February. The company has settled its class action for a price that was within the realms of what we expected, and it's much, much better place going into 2020. That didn't stop it dramatically impacting our returns across 2019 in a negative way. Internationally, our two oil services stocks that we owned at the start of the year there were negative contributors to performance. We've largely exited that space. We've still got a small investment in the UK, but oil services was a bad place to be in 2019. Stock markets, particularly in the US, but also here in Australia, are hitting all-time highs, and it's hard to go a week without someone talking about a bubble and the risks to the share market and all of the problems that are being caused by low interest rates around the world. There are certainly things to be concerned about. We're factoring them in, but we're actually quite optimistic about the portfolios that we've been able to put together, and that's because there has been very, very significant divergence in stock market performance. I was whinging about it last year that there wasn't enough divergence in performance and difference of opinion about the way certain stocks should be treated. And over the past year, we've seen a pretty significant gap open up between large blue chip predictable stocks that are seen as bond proxies and are very interest rate sensitive, and businesses that are a bit more cyclical, perhaps a bit less quality, that nobody wants to own. And some of those companies are quite high quality, particularly in the international side of things, but in both portfolios, we've been able to get the cash levels down quite significantly over the past 12 months, and I'm optimistic about the stocks that are in there. And I've found over the past 10 years that worrying about where the market is or where it's going to go is a futile exercise. And if you can focus on finding the right stocks for your portfolio, it's a far better use of your time. And you can view our cash levels at the moment as a fairly high level of optimism about the investment opportunities that are out there. Again, I think you need to steer clear of the consensus trades at the moment. I think big defensive stocks and a lot of US stocks are quite expensive, but there are plenty of opportunities in the unloved parts of the market and in places like the UK and even in the US to invest in some of those better quality cyclical businesses. Towards the start of last year, I participated in a podcast with Owen Raskovitz, and he asked me what other podcasts I listened to. And I was a bit embarrassed to say I hardly listened to any. And 2019 for me has been the year I really got stuck into podcasts. It's a great format. There's a huge amount of very, very interesting content out there. For me, I also spend a lot of time running, and some of the new devices let you run and listen to podcasts at the same time. So it's been a year where I've really enjoyed getting into that format and heard some fantastic content. Really love the Invest Like the Best podcast. We talk about Spotify in our latest quarterly report. And it's also something that Alex talks about in her interview. It's a really interesting business, and one of the ways I came across and started thinking about that stock was not only my own use, but an interview on the Invest Like the Best podcast with the founder of that company. So that's the thing that I'm doing now that I wasn't doing at the start of the year.